Hey guys, Mike here. So we got a short week ahead of us. We're going to set it up, go over earnings, all that good stuff. But I want to get into something more important. And you know my pet peeve, when people bring out stock market data in some little Excel spreadsheet or whatever, and they say, well, this performs this way during this time period or whatever, and then there's no context behind it. It's just a chart and it says, well, this company did the research and this is what they say. There's always something behind it, right? You have to look behind the curtain, and so that's my job, I feel, to do for you. And so now what you're going to see going around probably all week, the next couple of weeks, if you hadn't seen it already, I'm seeing it a lot pop up, which is the reason why I'm addressing it, is you're seeing this thing about the third year of the presidential cycle, right? Remember, I showed you guys, pull back the curtain on the Christmas rally, and what happens if you have these 3 check marks, the Christmas rally in the first 7 days, and the first month, all that crazy mess. And so this now is the third year, of course, of President Biden's term, right? And so what happens in the third year? And it's pretty crazy, the numbers, okay? And this is what I'm talking about if you haven't seen this chart yet. And this is the election cycle year by year. This was done by Charles Schwab from 1933 to 2015. And you can see the percentage of times it's up versus the average percentage. And what's crazy, when you look at this, here's the base of the first year, right? 47% of the time it's positive, only 5% is the average return. Second year, 62% positive, 7%. But look what happens to the third year. 90% of the time, the third year is positive, and it's a whopping 16.2% average. Triple some of the other years, double the second year, more than double actually. And the big question is, why is there such a big discrepancy from the first, second, and fourth year versus the third year? Because that is a huge difference, right? The presidents, all the presidents in our history, and it doesn't matter which party you root for or anything, and which one's your team, doesn't matter, I'll show you that. Did they get better at their job? Is that what it is? I mean, the third year, they're kind of getting comfortable. And the answer is absolutely not. And I want you to think about it just for a second. Why would the third year of a presidency show those kind of numbers when it comes to their stock market returns? What would skew the numbers so great like that, right? And I'll give you a second to think about it. But if you really think about it, I want you to really think about Bush Jr. and some other presidents like Reagan, Clinton, like what was going on, right? And remember, this stops in 2015. So I'm going to show you what happened after this as well. But check it out, guys. And it's very simple. And what's crazy about this, I actually discovered something on this more than anything else, is it has to do with a lot of presidents for whatever reason. This is Bush, for example, Bush Jr. He came in during the dot-com bubble. Well, guess what? In his third year, the freaking stock market bottomed. And so what happens when we come out of a crash? These crazy, crazy returns happen, right? The stock market just goes crazy. This is the S&P. The Qs were up way more than this. Now, it was up over 20% for the year for him, right? So that really skews this. Let's go back to Clinton. What happened there? You know what happened in his third year? The dot-com bubble started taking off, right? And just skyrocketed. That was the beginning of the dot-com bubble, was his third year. You think that's going to skew the numbers? Abso-freaking-lutely it is. Go back to Bush Sr. What happened to him? Well, look at that. His second year, stock market tanks. So what happens in the third year? Oh, well, look, it's another bottom. What's going to happen here? The stock market is going to roar. That's what's going to happen. All right, 20% move in his third year. Actually, I'm sorry, 31% move. Yeah, that skews the numbers, right? Go back to old Reagan there, old Ronnie. Look at this right here. Boom, a recession. I can't believe it. Oh my God. Stock market's coming out of a crash. Yeah, you're going to have big returns, 20%. Here's what's crazy. Remember, that data stopped in 2015. What happened in Trump's term, right? Comes up, crashes, right? This is when the Fed was trying to roll off their balance sheet, right? And we had the taper tantrum. What happens? It bottoms on December 24th, the end of the year. So what happens in 2019? It roars. It's coming out of a crash. 32% move. And guys, if you get anything out of this, please hit that like button. It really does help the channel. And if you're new here and you like this kind of content, think about hitting the subscribe button. I really appreciate it. And we look at like Obama's, for example, he came in. Well, of course, the stock market bottomed in the beginning of 09. So 09, 010 were his big years, the first and second year. The third year, what happened though? Remember? Does anybody remember? I talked about it. You had the debt ceiling, right? These idiots became morons up there, and we ended up losing our AAA status, going down to AA because they almost default to like morons up there. And guess what? The stock market still ended up positive for 2011. It wasn't great, but it wasn't negative. All right, because remember, the stock market in the majority of the time is going up. It's trying to go up. That's another reason why you see these numbers kind of skewed. But the biggest part, and I went all the way back. I'm not going to put all these in there for you. It's boring. All the way back. And you'd be surprised the percentage of those third years that are coming or very close to coming out of a recession. I don't know what it is with that, but I looked at it and I said, huh, well, that's pretty good data to know from here on out. I don't know why that always happens in the third year. A lot of the times, I looked at every single one of them, and guess what was happening in 33? We were coming out of the Great Depression. That was huge gains, by the way, coming out of that one. It was 34, 35, just massive gains, right, in the stock market. So, that right there is the reason why those numbers are so skewed. What's happening now? We're in the third year of President Biden's. What just happened? We just had a huge crash when the market got ahead of itself, thinking there was going to be a recession, crashed the market down, and now it's running up, right? Now, does that mean, that's going to continue to happen? Of course, nothing's guaranteed, right? Nothing's guaranteed at all. But when you look at that and you understand what happened, we're coming out of a crash here. I can't believe stocks have started to rebound some as they got ahead of themselves in the crash part, and also understands the first 6 months of the year that are the best, right? And what are we calling for this year? Probably second half, well, maybe the second half, maybe even pushed all the way to the first quarter of 2024, which when things can get really bad with the high interest rates, high inflation, that kind of stuff. And I'll talk about that a little more tomorrow. With one of the calculations they do of what's really affecting these numbers on inflation and stuff and how stupid it is that they're doing this. But, just that's the reason why when you see this going around, say, I understand now. From here on out, I understand. And also, this is something I plan on using going forward. I mean, when you look at it, you go, well, you pinpoint something. I still don't know why it's usually the third year when we're coming out of a recession or a crash without a recession. But, it seems to be the case. It's just freaky like that, right? And again, I implore you to pull up the presidential years, pull up a chart, and look at it. It's pretty fascinating to see. And so that gets us into, obviously, this week coming up. It's only a 4-day week, right? So short weeks. You tend to see not as people getting involved on short weeks, but also that's the reason why Friday was so just dull, right? With even the options, because 3-day weekend, people definitely don't like to hold in this market, right? They kind of just stay off of it. And plus, maybe they went on early vacation too. But looking at the S&P, and we're going to pull a lot of indicators out on this one. You can see we broke down below that double top support, which was big, right? Now it will become resistance. We left a gap there. So we're going to see if we fill that gap. And if we do, obviously we got a little more resistance up above us now if you try to get to 4,300. But also, just looking at it, I mean, the targets are 43, 3,900. If you get to 4,300, that's going to be around 6%. If you get to 3,900, obviously it's around 4.5% now. So either way, not a big difference on that. And the question is, will we be allowed to move? And we'll talk about that in a minute. But when you look at the moving averages, if we do go down to 3,900 and it's a fast drop, because remember I showed you all those VIX call options people are betting on, we could break that 200 again, right? And it'll be even crazier if we go down fast enough. You could have the 50 crossing over that 200 again, which would be nuts. Right? We've never had that happen, at least going from the 1970 up. I've showed you the charts, right? Once you get that golden cross. So, we're going to have to see on that. But you see, what do you see? The 100 is curving up. 50 is still heading up. The 200 is trying to flatten out itself, but we'll have to see. We'll add in the 5-day moving average, which a lot of people like. Obviously we broke through it. It's turning down now. We could get one of these where it turns down, then we pop back up. Or if you look what happened before that, a nice sell-off. So we can look at that. If we bring up the 8 and 21, which is another group of moving averages people like to use, and it's very powerful, especially in the daily. And it's the 8's turning down, heading across the 21. And obviously when that happens, you can see we usually get some decent sell-offs. When it crosses up, we usually get some decent run-ups. So that's something another we're going to have to take into consideration. If we go through here, obviously add in your MACD and your RSI. The RSI has not crossed the 50 yet on the daily. We did have the bearish MACD cross on the daily. On the shorter term time frames, we've actually had the bullish cross. But then point out, look at the weekly, it doesn't look anywhere near as bearish as what people think, right? I mean, your RSI is still setting new highs, still above the 50. MACD just crossed the 0 line. So again, we're going to have to see where it goes. And when looking at options, you can see a lot of options at 410, 415, 408's the puts, 406. And so, it depends on where the market makers are going to let us go, because we know that's what controls this market right now, right? And then another one to look at is going to be Tesla. I'm not going to bother looking at the chart. I'm just going to look at this right here. These are the options, right? 220, we hadn't even got 220. I think 217.40, I believe, is the high of the year so far. But you still got all those 220 call options, again, below anywhere from 160, 180, 200 on your puts. And you can see, I believe the put call ratio is like 0.7 or something. So a lot more calls than puts. A lot more people are a lot more bullish on this. And that's usually what causes these gamma squeezes in Tesla, right? And that's why you see every dip is getting bought up, right? Everybody is just piling into call options. I showed you they got 250s, 300 call options out there right now. And so and again, Tesla is just, as somebody put it in the comments, and I agree, it's its own ecosystem, right? It's totally different. And NVIDIA is another, NVIDIA. And Tesla kind of the same way with their huge retail. I showed you what is it, 7.9 billion since the beginning of the year is rolled just into Tesla from retail investors. And one thing that scares me is somebody said in the comments, and it may be true, and I saw it on Twitter too, which they were saying, big money's kind of setting it out, and retail is pushing this market up, and especially because of options and everything and what they do and how they affect the market and stuff. And it's kind of a retail traders are taking over, because 20% of all trades now are retail traders. It might be 25% now, right? And that's kind of scary, right? People start thinking that, like, oh, retail's taking over, this time's different, and you're like, come on, man. I mean, seriously, we can do so much, but no, if big money is not behind a move, the move is going to be unsustainable. That's just the way it is. And right now we kind of see that they're more going into bonds, things of that nature. But now, is some big money getting in? Of course, right? And I think the one thing to keep in consideration, I was thinking about this today, is you got to think, we're in uncertain times, right? And there will be many books written about, from 2020 to 2023, whatever, and I will buy them and I will bring them on this channel to show you of how, they're going to write this. But you got to remember the age of the people now that run these hedge funds and these pension funds and, the big money, right? They move in and out of these markets. How many of those people, what percentage you think were actually adults and running hedge funds and pension funds in the 1970s, which is the only time we can actually look and go, okay, we had really high Fed funds rate, really high inflation, right? And so how many? What 5% max? Really? I mean, think about that, because if you had to get a degree back then, let's say it was 1972, 1973, you came in, you were 22 then, right? So add about 48 years on. So what are they, like 60, 65 years old, still running the pension funds? Maybe, right? But most hedge fund managers I see and pension fund managers I see most of them are younger. They're in their 30s and 40s, maybe 50s, right? So they weren't around. They're just reading books trying to navigate this whole thing. Right, and all of a sudden, a lot of them came in, took over after the financial crisis, so there was no other option besides stocks. Now they're like, oh my God, we can buy fixed income and make money? Yeah, you can, right? And so it's going to be interesting, because, and the crazy thing is what's going on in crypto right now, right? That's the riskiest of riskiest, and even when the stock market is going down, crypto is going up right now, and that's even crazier, right? Well, we know how heavily manipulated that is. But still, it's interesting to see that. And some people were saying, well, maybe crypto is leading the markets, and when it goes up, the stock market's going to follow them. I don't know about that. We're going to have to find out. That's a whole different ball game. But just keep in mind, like, who's actually running these funds now. Okay, it isn't. You got your Ray Dalios, the billionaires. You know what I'm saying? But for the most part, most of these funds, the big ones, the pension funds, aren't run by people in their 60s and 70s. They're run by people like 35 to 55 years old, somewhere in there. They weren't running those funds in the 70s. Okay, so they're literally just doing what Jerome Powell said, our models don't work, right? And these pension funds models don't work, and these hedge fund models don't work either in this mess. They're trying, but all the indicators are off, because if you look at all the recession indicators, they are screaming we should be in a recession right now. Okay, and that's just not the case, right? And so, just want to put that out there to you. Let me know what you think down in the comments. But going into earnings, it is a loaded earnings week on some very popular stocks. And you can see, Walmart, Home Depot, again, we're going to get to find a lot about the consumer, Coinbase, about crypto. Crypto's been going up, so I expect them to report at least decent numbers. And Toll Brothers, we're going to get to find out all about the housing industry, public storage. Remember I told you about the public storage and stuff like that? Going up and stuff, and so that's one to watch and see what they have to say. As far as how many units they're building and all that good stuff. Remember, they build a lot of units when they see recessions heading this way. And then you look at, in the morning time, I don't see much going on, but then there's NVIDIA. That's going to be a really big one. Huge run up so far this year, right? Lucid, Unity, Etsy, Teladoc. That thing's been on a tear too. Alibaba, we're going to see that's been selling off lately, trying to make a nice comeback. We'll see on that, because the Chinese have flooded the market with liquidity now. Block, or as you know, Square, Carvana, still don't know how they're in business, but the stock's up like 400%. Booking, obviously, are we still traveling? Wish is a heavily shorted stock, so we'll see how that's going. Beyond Meat's another heavily shorted stock, and so we'll see if the young folks getting involved and trying to push that one up. Cinemark, I want to see this because the movie theater is always full now. I just went and saw Ant-Man with my son, and it was just packed out. So, and it's not cheap anymore to go to the theater and stuff. So, that leads us into the economic stuff. And I mean, it's a pretty full week. But again, a 4-day week is nothing that should move the market besides this right here. FOMC meeting minutes, which means your dot plots are going on Wednesday, right? So we'll see if they're increasing, right? How far they think they're going to go up on the interest rates and things like that. And then as far as the cuts, if they show any cuts, right? Has anybody changed their mind? That's going to be the big one. That one could absolutely move markets because the bond market's been screaming about this and the stock market's just been ignoring it. And so that's why a lot of people are betting on those VIX calls. Unemployment claims is going to be a big one. Are we still having a hot job market or not? Core PCE price index, personal income, personal spending, right? That's a big one. How healthy is the consumer? That's what they're going to be looking at. New home sales, I don't think any of this matters or even going to affect anything. But we want to know, about inflation expectations, consumer sentiment, which has been going up, right? Since the stock market's been going up. It's amazing how that works. Oh my God, the stock market 401ks are going up. We feel great, right? And they were seeing inflation coming down, but how is that going to flip? Now they just saw inflation actually not hit the numbers and it missed it. I mean, especially month over month and PPI by a mile as far as I'm concerned. And we'll go over, kind of tomorrow why some of that is. But again, when you change the way you change calculations, shockingly, you get different numbers. How about that? So anyway, let me know down in the comments what you guys are doing, what you think about the week and stuff, where we're going. Are you picking 3,900 first, or are you picking 4,300? That's really the big question, all right? So if you got anything out of it, hit the like and subscribe button. I really appreciate it. Let me know in the comments what you also think about that third year of the presidential cycle and stuff. I thought it was very interesting. So anyway, I'll see you guys tomorrow for another busy day.